All right, welcome everyone. Today we're diving into a really critical question in decentralized finance. And to do it, we're going to use 200 years of financial history as our guide to build a complete framework for actually understanding risk. Okay, so here's our game plan. We're going to start by totally deconstructing a common myth about liquidity. Then we'll build our framework, layer by layer, digging up some pretty incredible lessons from major financial crises. And we'll wrap it all up by putting together a complete diagnostic tool that you can apply to, well, any position you hold.
It sounds so simple, right? It feels like a fundamental question. But as we are about to find out, the answer most people in DeFi give you isn't just incomplete, it's actually dangerous.
You see, most people in this space seem to think liquidity is just a matter of pool depth on a decentralized exchange. But that's only 1/4 of the story. Trusting that alone is kind of like judging an iceberg by the little tip you see poking out of the water. So let's kick things off by tackling this liquidity illusion head-on. Because this right here is the first, and I mean the most common, analytical trap that gets DeFi investors into trouble. This surface-level thinking completely ignores 3 deeper, way more fundamental layers of our financial infrastructure. You know, these are the layers you never, ever think about during a bull market, but they become terrifyingly obvious the moment they fail in a crisis.
Okay, let's move to our first layer, the one everybody sees, the pool. Now, to really understand its limits, we have to hop in a time machine and go all the way back to a major American banking crisis in the 19th century. So on the left, you've got President Andrew Jackson basically declaring war on the second bank of the United States. I mean, this bank held up to 40% of the entire nation's gold and silver. He effectively yanked the deepest liquidity pool right out of the system. And on the right, well, that's its modern DeFi equivalent, a governance token that looks great on paper, but has a tiny 200K pool of liquidity on a DEX.
And here's the key lesson from all that. When the Panic of 1837 actually hit, even people holding physical gold couldn't do anything with it. The asset itself was safe, sure, but the entire system for exchanging it had just vanished. The market depth was gone. Your gold was just a very shiny rock. So, this brings us to the first crucial diagnostic question. It's the most basic check, but believe me, it is only the beginning. Can you actually sell your position without completely tanking the price?
But you know what? Deep pools are totally worthless if market-wide confidence just evaporates. And this brings us to the second, and I'd say critically overlooked, layer, the backstop.
Okay, so before 2008, there was this huge $13 trillion offshore market for US dollars. It was called the Eurodollar market, and it worked perfectly without any direct regulation, until it didn't. When it froze, the entire global financial system just shuddered. And this, folks, is a chilling parallel for today's major stablecoins, which kind of act like a retail version of that system, but with no committed lender of last resort.
The scale here is just staggering. When that supposedly private money system broke down, the Federal Reserve had to jump in with $600 billion in emergency swap lines. They were literally forced to invent a backstop for a system they didn't even create.
And this leads us to our second critical question. When the panic sets in, when everyone is selling everything, who steps in to put out the fire? The Eurodollar system, it turns out, ultimately had the Fed. So what does your stablecoin have? But okay, even with deep pools and some kind of theoretical backstop, liquidity is completely useless if the financial plumbing, the pipes, breaks down.
So back in 1974, a German bank called Herstatt failed right in the middle of the business day. This created a massive settlement crisis because banks had paid out one currency but hadn't received the other yet. The problem wasn't the value of the money, it was a complete and total loss of trust in the system that moves the money. This is the exact same dynamic we see in DeFi with these catastrophic cross-chain bridge exploits.
And look at this. In the 3 days after the Herstatt failure, the total volume of funds moving through the interbank system dropped by 60%. The money didn't disappear. The pipes were just too terrifying for anyone to use.
And that forces us to really question the plumbing. Yeah, your asset might have deep liquidity over on another chain, but can you actually get it there? Safely, reliably, especially when everything's on fire? Are the bridges you're using truly battle-tested?
And finally, we get to the master layer, the one that ties everything together. And its importance was probably best shown by the rise of the most powerful financial family of the 19th century, the Rothschilds.
See, before the Rothschilds came along, financial markets were incredibly fragmented. If you wanted to turn gold into, say, a Prussian bond, it was a super complex, multi-step headache. What the Rothschilds did was create a single hub in London that just absorbed all that complexity, connecting everything.
And honestly, today's DeFi landscape, with all its isolated chains, looks a lot like pre-Rothschild Europe.
And assets liquidity gets magnified, like exponentially, when it can be easily and efficiently converted into other types of assets. The Rothschilds got it. They understood that true liquidity isn't just about selling, it's about transforming.
And this is our final diagnostic question. Is your asset part of a deeply interconnected ecosystem, a real hub, or is it basically stranded on a digital island with no easy way to get to other markets? So, now that we've looked at each layer through the lens of history, let's put it all together into one single, powerful diagnostic tool. Now, this slide perfectly shows how the framework is cumulative. Notice the order. A failure in a foundational layer, like the pipes at layer 3, makes everything above it totally irrelevant. You can have the deepest pool in the entire world, but if you can't actually move your asset there, it's completely worthless. So for long-term capital preservation, the health of these deeper layers, the hubs, the pipes, the backstops, is way more important than just the surface-level depth of the pool. Ultimately, this whole framework, it's designed to shift your perspective. It forces you to ask the one question that separates the survivors from the casualties in every single financial crisis, past and future. Not what is my asset worth on paper, but in the heat of the moment, when it all hits the fan, can I actually use it?